Okay, guys, so we're live. And as usual, I'm checking the connections. And if you guys can hear me, I'd love to hear from you that you can actually hear us. So give us a holler. We can hear you. Everything is good. Let me see. It seems like we are on. Yes. Okay, cool. So it looks like it's live. It's going well. And I'll start the show officially now. Hope you guys are doing well today. Okay, let's start. Hi, guys. This is Yishai Breslauer, the CRE Shark Eye Show. And today we have a treat. I hope you guys are doing fantastic. Usually on Thursdays, I like to have some inspirational stories, some good stuff that when we go home, we have some good feeling about this, about the weekend, about what we did for the week, and to give us a little bit of charge, to recharge a little bit about, charge a little bit of power, get a little bit of energy so we can get back next week having, new forces, new vision, and stuff like that. So today on the show, we have a guy I know for quite a while. His name is Avi Abadie of AMS Acquisitions. This story is pretty cool because it's a story about two guys who really started from scratch, from nothing. And that's what we're going to hear today. And without further ado, I would like to get him in. And Avi, thank you for being here. I appreciate it. First of all, it's great seeing you. Haven't seen you for so long. How are you?
Likewise. It's great to see you. Hopefully in person soon.
Please God. Hopefully in person soon. Excellent. And we just had an opportunity to see your beautiful family. I hope you guys are doing okay during these crazy times. Not simple for everybody, but you have a really, really unique story. And we had a couple, for a couple of years, we had a chance to catch up and schmooze about this. And this is one of the inspiring stories that I know. And how about you share with everybody who's listening a little bit about you, a little bit about how you started, you and Mikey, and you alone, you and Mikey, and together, and so on. Go ahead.
Sure. I guess I'll start it after I came back from my year in Israel. I had, before I started college, I had 2 internships that summer. I was able to do 2 internships in one summer by splitting up the week, 2 days at one place, 2 days at another. And one of the places was actually at Besson and Associates, in their investment sales division under Adelaide and Paul Sinelli. So that was really my first taste of real estate. We were putting some decks together, some presentations, and
you made a license. You became a licensed broker? No, not really. Just under that umbrella, you started
helping out, putting some OMs together. I was 19. I just turned 19 years old, getting a little taste of the real estate world. And these OMs, they caught my eye, and I said, this is incredible. You could buy property, get some income. It's really intriguing. And the other internship was at Merrill Lynch, wealth management, and that wasn't as exciting to me as the real estate. Real estate was tangible, something you could go and visit and fix and really add value with your hands. So the next summer, I got another internship in residential. I think I did that for 2 summers. And then as I left college, I got a job at Crown Acquisitions. People who might be familiar, a lot of people are familiar with Crown Acquisitions. If not, it's owned by the Chira family. And what I did there was they had 2 divisions. They had the acquisition department, and they had the retail division where they did a lot of tenant representation. So they work hand in hand. They're a retail-focused acquisition company, and they dealt with a lot of retailers. So they cultivated those relationships in order to know where they wanted to be and hopefully be able to buy the buildings and make that match. So if there was a situation where the owners didn't want to sell, at least we can make money on a lease by brokering some of these retail leases. So that's where I got my commercial experience and my feet wet there. I was there for close to 1.5 years. And Mikey, my partner, he was working with his uncle and his grandfather. They were doing some boutique condos in Brooklyn, ground up construction, and he had aspirations to start his own company. And he gave me a call one day. He said, "Let's go to dinner." So I said, "All right." We at that time, I think we were 23 years old, and he said, "Let's start our own company." So I thought to myself, I'm still living at home. I don't have much to lose.
That's the best start. That's the best. By the way, everybody's listening. That's the best time to start. Best time to start, because you don't have a big family, you don't have huge mortgages, you don't have that obligation on your head, and that's really great timing. Go ahead.
Yeah, so I thought to myself, I'm living at home, not much expenses. What do I have to lose? Worst case, we do it for 1 year, 2 years, 3 years. I'll be 25, 26. If anything, I got great experience, and then I could go get another job. God forbid it didn't work out. So my downside, I felt, was protected. And I felt, always something I wanted to do. And when you don't know what you don't know, it won't scare you.
Exactly.
So, that was definitely helpful in that regard. But so I figured, let's go out there. So Mikey and I, we decided to start our company. We didn't have an office. We didn't, come from big money. So we were working out of my two younger brothers. They shared a room. We worked out of their bedroom while they were in Florida for the summer. So when we started, and shortly after that, we rented a small office at One Penn Plaza in someone else's office. So we sublet a little room from them, and we set out to buy properties in and around New York City. We were looking at anything, that we felt, we could potentially raise money for, anything that had value. And just a side note, we had to pay for this office. We had to, so we each, Mikey had made some money doing some introductions, prior. I was giving some bar mitzvah lessons. I was reading the Torah and running the youth program at the Safra Synagogue. So anyway, we're able to make some money to be able to, I guess, invest in ourselves and invest in our new company. We did, whether it's, nights and weekends, etc. So happened to be, it took us about 1 year to put our first property under contract that we were going to close. And so we started in about May, June of 2012. And it happened to be that time, 2013, that we ended up tying up a piece of property in Ridgewood, Queens. And at that time, no one was really investing in that area. We saw it as the area, the neighborhood right next to Bushwick. At that point, Bushwick was heating up. And this happened to be an off-market 8 cap. And, don't really exist anymore. But, that was...
maybe soon.
Maybe they'll come, right. Yeah. Maybe come back soon. But at that point, we modeled out the deal. It looked like it was making 11-12% cash on cash day one annually, and we felt that Ridgewood had some good potential. And what we like to call it was the low risk, high potential reward model, where if things stayed the same, they were very low rents. It was all free market, and it was 8 apartments, 3 retail stores. We felt to stay the same, great. If it grew, even better. So, we felt also that our downside was protected there. And if things got cut in half, which free market rents that, if they were cut in half or whatever it may be, that, rents that New York has never seen. So we were getting $1,300 on a 1-bedroom. It's $1,500 for a 3-bedroom. It was, very, very low rents. And so we ended up tying up the deal, but we actually got introduced to the deal by Dan Levy at Ashkenazi. He's currently the president of Ashkenazi Acquisitions.
Right. That's a pretty big company.
Yeah. So we know Ben. So Ben introduced us to Dan, and Dan showed us the deal. He said, "I'm looking at this, but it might be too small for me." But we had spent a few hours talking about a different deal with him, and he brought this one to our attention. We said, "We'll take a look at it." We wanted it. And so we set up our first meeting in his office with the seller. So he said, "Don't worry, come to my office. We'll set it up.
That's excellent."
Yeah. And then, so it was he really staged that meeting where, the seller can feel confident that we can close on his property.
Now
So
tell me something. Let me ask you a question. You went on that first property and you said, okay, we want it. Okay, it looks like a good deal. It looks like a win-win because the downside is not that scary. Okay, we got the whole point. You don't have to share exact numbers, but approximately what the size of that deal, and meaning
sure, yeah, we were all in for about a little bit over 4 million.
a little bit of okay.
The purchase
So
price was 3.6.
so here's the question: how are you guys, as new guys who are not in, no experience, no nothing, or getting in, doing youth programs in the synagogue and all that stuff? How do you guys get a loan, and how did that work? Meaning we'll talk about the equity part soon, but how do you guys get a loan? Meaning that's the main part of money.
Well, I think before getting the loan,
all that stuff. Yeah, go ahead.
I think before getting the loan, you should have asked me, how did we put up a deposit?
Exactly. That's it. Okay, that's a better question. How'd you put up the deposit?
So we got a 5% deposit, and the 3.6, and honestly, we had to scrape around to put that up. I liquidated my bar mitzvah, portfolio, be able to put that up. We did whatever we can. We borrowed some money from family members, anything we could to try to get that property under contract. Yeah.
Beautiful. Okay, so you got the deposit, you got some family members.
How did we get a loan?
How'd you get meaning the equity probably was crazy, but I'm saying, how'd you get the loan?
It's a good question. So at that point, we were putting a book together, right? And we realized, okay, we need to get a loan, and we weren't. No bank would give us a loan on this property with A, no money in the bank, and B, no experience. And I think one of those things, you could have money in the bank, no experience. We didn't check any of the boxes. And but we knew the deal was a great deal. It was cash flowing, and if we could get someone on board to help us get that loan, that would solve our problem.
Right.
So my father's a rabbi. He's a doctor. His if anything, he's given me really the greatest gift, which I think is his Rolodex. Instead of all the money in the world, give me your contacts, and that was a gift from him. So he would put me in touch with people in the business, and if he knew them, make introductions for me, not charging for free. So one of the people my dad knew and my family knew was Joe Sitt from Thor Equities.
Oh yeah, yeah. So big name.
Yeah, so we called Joe, and
a very aggressive style of investing. Yeah.
So we called him up, and I said, "Hi, Joe. It's Avi Abadie. We have a deal under contract. We need to get a loan." So he says, "Okay, so call a mortgage broker." And I said, "No, we know how to get a quote. We need someone to help sign it for us."
Right.
So he said, "Show it to one of my acquisition guys, and if we like it, I'll sign it." So we were shocked. We're like, "That's it?" So we're all nervous. We put our book together. Again, we're 24 years old. We were putting a book together. It's also right. It's a $4 million deal. We make an appointment with one of his heads of acquisitions, and we're waiting there for him to come in the office. He sits down. He takes a look at our OM, flips through the pages. We're there, all nervous.
You're talking about the acquisition guy.
Yeah.
Or Joe. Yeah.
No, the acquisition guy. So he's looking through the book. We're all nervous, not sure what he's thinking. And then, takes a look at his 8 cap, multifamily, New York City. Sure. So after a few minutes, it was maybe 5-6 minutes. And he's like, yeah, definitely. Obviously if the due diligence checks out, things like that.
Yeah, of course.
But the metrics, he said, yeah, this seems great. No problem. If Joe's willing to, this is a good deal. Joe's willing to sign. No problem. So that's pretty much how he helped us with the debt. He spoke with the banker. We got our first loan from People's. And
so you created a partnership with him, and that's how you made the first thing, because you signed the debt and he got you in the game. So
exactly. We told him, listen, well, by having you sign on the deal, you're our partner. We'll give you a piece of our promote. We can use you as help. Anything happens, yes, sure, no problem. And and basically that's how we got our loan, and it definitely helped with the equity as well.
Beautiful. So he helped you with equity also, or you had to go and start fetching all around, starting to raise capital?
Yeah, we wanted Joe to put in, but very little. So at least it gives us the opportunity to raise almost the whole thing. We didn't want to run into the problem. Oh, Joe's helping us with the loan. He's our partner, but he's not putting in any money. They don't, people didn't want to see that there was some shakiness there.
Right.
And so he put in, our total raise was 1.4. He put in a little bit, very little. And it was up to us to go get the rest. And, we were scraping names from people who know people who know people, whatever it took to be able to get that equity.
How long did you have?
We had about 3 months. 3 months.
Yeah, 3 months. Okay, that's pretty decent time to run around.
Yeah.
And, okay, so it's pretty decent time to run around, and you made it, and that's the main part. That's the main part. It just shows that everybody's listening to this. It's just amazing. Just that's a lesson I always tell people. I mean, they always ask me, so how do you do the first thing? How do you go with the first thing? And I think that the first word is humility. Meaning, if you're humble enough, meaning, first of all, you are a go-getter. You're a hustler. And that everybody knows. You have to be a hustler, yes. But once you understand that you have to be humble and to have someone to help you get in the game, that's exactly what you did, and that's exactly what people should do. So that is the key. That is the key to success, especially for young people. So that's awesome. I love that story. So tell me something. Let's shift a little bit. Okay, so you had a first deal, and from that point, I'm assuming it started rolling further, and the bank started looking at you because you had one deal already. So that made things a little easier. Let me ask you this. Okay, so you started a deal, and what type of asset classes you guys decided to go for, and why at the time?
Sure. So I think when you're starting off, if I had to do it again, you want to be able to pick a certain niche or strategy or something that you can really replicate over and over again.
Exactly.
So it was tough because we're playing in the most competitive market, arguably the most competitive market in the world. And things were picking back up at the time, 2012, 2013, 2014. Really, things were growing and growing, and things were moving. And two young guys with not much experience at all trying to compete with larger companies was difficult. So we kind of felt if we were going to play in the New York market, we had to be a little bit open, a little bit more opportunistic, and try to find deals that would make sense. I think because of our first deal, a strategy was born. It wasn't necessarily asset type, but it was more of a market strategy. Try to find areas in and around New York City that we felt would have a big growth potential, and it could be on several different indicators that we look for. Commuting times, whether the transportation's there, retail landscape, because we were trying to attract a certain demographic, which happens to be young people, young professionals, after college or in college really till 40, let's say, and even sometimes empty nesters as well. And we felt our demographic was kind of easy to target based on us knowing exactly what we would want if we were the renters. So it was really a market focus that kind of emerged, and we would look for the best located assets within those markets. So it could have been, depending on where we saw growth in terms of which asset type in those markets, but it could be retail, multifamily, office, anything really that we felt could and will grow.
So let me ask you this. Okay, so there's a general rule, when it comes to definitely retail, meaning also office, but definitely retail, that the knowledge base of real estate is a lot wider. You have to know a lot more about retail when it comes. Multifamily is not, it's a no-brainer, meaning you have to know a lot. You have to understand how to calculate the management put in, understand how well and the NOI works, and the cap rates work, and all these things, and IRR, all these big words that we try to understand and when we go to an acquisition. But when it comes to retail, you need to know a lot more. You need to know what type of retailers are required in the area. You need to know what type of businesses are wanted in the area, are needed in the area by the people, what type of retailers are there already, all kind of metrics, the road, the car, the counts, all these things. How did you guys get to that? Meaning at that point, you were 24, 25 maybe. And
Yeah. So so we never attacked retail, the high paying retail, 500 a foot, 1,000 a foot, 400.
nationals, or you did nationals.
No, wasn't whether nationals, not nationals. It was more of the neighborhood type retail. Yeah, we weren't looking for high priced retail, not in Soho and not on Fifth Avenue. Those, you might look at those as flagships, and where tenants might not be making some money at the pricing that they're paying. At least at that time, retail rents in those areas kept going up and up, and we felt either it wasn't for us, we didn't want to compete with that, it was too rich. And so some of these areas like Ridgewood and Bed-Stuy and some of those other neighborhood type retailers, the price per foot was much lower, and the tenant pool became much larger. So we weren't looking for the retail to really make the whole deal. It was most of mixed use. So you have apartment upside, then you could have retail upside.
Yes.
And whatever, all those details within retail and understanding the retail corridors, I learned a tremendous amount at Crown. There was a lot of, you might think one street, but the corners across the street from each other could be completely different.
Unbelievable.
So, and where's the foot traffic? Is it more on one side of the street? Where does the sun hit? I mean, all ceiling heights, voltage, there's a lot of different types of, details that, like you said, people who haven't done it or don't know it so well, they wouldn't realize or even think about these things. So what we would do is we would look who's in the area, try to get some comps in terms of even some sales comps within that the retailers are doing. You look at the obviously the rent per foot that they're paying to understand what you can get, and in the spaces that you're looking to buy, are you out positioning some of the competition that you hope to bring in? Are you in a better location? Which retailers are in the area and aren't, and who want to be? You look at similar corridors where they have similar retailers and try to find the ones that are missing. You try also picturing yourself as a retailer. What would I want to open up this market? What's missing? What should be here? What's a good complement to your tenants that are next to you? So, there's a lot of different things that you look at, but again, it wasn't high stakes in terms of, the Soho or, Fifth Avenue, where you're really, trying to attract that very, very high payer. We were looking at retail rents in the 30s and the 40s, per foot. So it was more neighborhood type retail, coffee shop or Subway or any of those type of chains, etc. Yeah.
Tell me something. When was the point when you guys realized that it's time to scale up? Meaning, okay, we bought maybe 1, 2 properties. Boom, our business is becoming from here. It's going one level up. I'm not talking about where you're today. I'm talking to the one level up.
Correct.
Okay.
So
when did you realize that?
So our first deal was a total of $4 million. Our second deal was $45 million.
Wow.
But the first deal we were, managing the building ourselves. We were the sole GP. The second deal we did happened, and like I mentioned, we were trying to be opportunistic, trying to find deals. We did our second deal. It was an office building in Connecticut, in downtown Hartford. So, very different from New York. And so there was a co-GP that we were introduced to. He was trying to raise for the deal, and we met in our office. We started looking into the deal and we did some due diligence, and it was being bought off of a fund, but off market. And so we were intrigued by that. We went to go see it. It was 92, 93% lease at the time. It was throwing off 9, 10, 11% at the time. And we felt it's good cash flow. They were distributing it every month. We could carve out a nice chunk of the GP for us to raise. And we got to know them over that time, over the next few months. And we decided to go into that deal. We looked into it. We felt good, comfortable. And felt like that market also had some legs. There were some buildings being converted to residential, and we're becoming more urbanized in the downtown. So we felt good. And we raised a total of 5 million at the time. Now I think we're in for a total of about 6, but the total equity raise was 15.
How'd you guys get to that? Because in the beginning, the first deal was not even nearly as
Yeah,
much.
right.
So what made it possible that you guys could get to those amounts in terms of equity raise?
So what we did was we had a family that put into our first deal, and thank God it was going well. We're paying distributions every quarter, and we called them up after we had that meeting. We sent them over the deal, try to gauge how they felt about it, and three other investors also, and there was some a lot of positive feelings. So we decided, once we heard some positive feedback, even without full commitments, we felt pretty good that we wanted to take that on us. We went from a $1.4 million raise to now 5. It was a very large jump, but I guess after initial reactions, we felt confident that we can do it. We ran around. We tried to get as much. It was cash flowing. It's very different from some of the New York stuff. So
it sounds good. That's how you build track record. That's the way it is. So
right.
Very, very interesting. Tell me something. Okay, so you got to that point. You got to this deal, and you're growing. Very cool. Then we start going to all kind of asset classes. Tell me a little bit about your experience with the office sector.
Sure. So being a co-GP on that deal, we weren't managing the deal. It was a third-party manager, and our partners were asset managing. And we would have calls with them, meetings with them to, keep getting updates and reports, etc. So we learned a bit about office there. We hadn't gone into another office deal of our own that we would manage until 2017. December 2017, we bought an office building in downtown Yonkers. That is right across the street from the Metro North Station. It was a smaller deal in terms of the square footage. It's total 70,000 feet. It's retail on the base, 5 stories of office. Each floor is around 12,000 plus feet. And we felt that market also is a market play. We felt downtown Yonkers had a tremendous amount of potential, being that you have the train on the waterfront and you're under 30 minutes to Grand Central, and it's really an incredible place.
I think you showed me that property at the time.
Yes.
Very cool. All
yeah.
Right.
So we didn't get much into office besides that, and we did a pref equity deal on office with our partners from Hartford, but otherwise sticking mostly to whether it's land or mixed use properties.
Interesting. Tell me something. Tell me a little bit about the residential experience that you guys had, multifamily.
Sure. So in Ridgewood, our first deal, we bought, like I mentioned, rents were around anywhere from as low as $1,100 to $1,600. So we had hoped that market would slowly grow and really turn out to be a great investment. What we didn't know is how fast the growth happened, and within 1 year, our rents almost doubled, year and a half from when we bought it. Because as we had hoped, we didn't know how much time it would take, but we hoped that people from Bushwick would flow into Ridgewood. And one of the biggest reasons we felt that would be very possible, because Ridgewood was known as a very safe neighborhood. So we felt that people can move right in there. It's clean, it's nice, it's safe. You have a whole nice retail street on Myrtle Avenue there. So there's a lot of things that they'll be able to service the new tenants coming in. And our rents almost doubled. Our 1 bedrooms were getting $1,800, 1900. 3 bedrooms were 3,000 from 1,500, 1,600, and 2 bedrooms in the mid 2s. So 23 to 26, depending. And we saw growth pretty quickly. And we felt, okay, this could be a great strategy to find those markets where you get nice big pops.
Interesting. So, tell me something.
Mm-hmm.
How can you define where you guys were pre-COVID? Meaning, COVID was going to be something we're going to talk about in a second, but sure. Pre-COVID, where you guys are at? Meaning, you guys grow, thank God, and you get to the point where you are a substantial company. Where are you pre-COVID?
So right before COVID hit, we are heavily invested in downtown Yonkers, and we have in Bayonne, New Jersey as well. We actually bought a property, a little different strategy, but there was a property in Sayreville, New Jersey, a little like Central Jersey but the site is unfortunately the developer passed away, and the site was about 4+ acres, and he was going to build 2 buildings for 55+ age restricted multifamily, and the first building was almost complete. And per our contract, it had to be completed with a C of O. So we got lucky to be able to start leasing while we were under the contract of the first building, which was 80 units, and the second building, 56 units, but it wasn't built. We just had approved plans, basically shovel-ready site. So we ended up closing that deal. It was about $13 million purchase, and leasing up the first building. Well, we closed with a construction acquisition loan, and we actually are completing the building now and getting TCOs on the new thing. So we fully leased up the first, and that second building is now being leased and finished. But we sold the property at the end of December. So that was another sector that we, pre-COVID, that we were doing. We were understanding more. We were seeing that it's a great opportunity, especially because the turnover is very low. People move in there, they're not looking to move out for the next concession. It's not like our demographic where they'll bounce from building to building, waiting to get those month free, 2 months free. So people came, they stayed, and they also paid. Collections were great, and turnover rate was low. It's very good, steady cash flow, and we felt we can do a lot more of those. Thank God we built it well, and we had a great experience with our GC, and it was a great experience overall.
Awesome.
So that was pre-COVID. We had hoped to do more of those, which we still hope to do, but it kind of gave us a little bit pause on the market. But in Yonkers, we bought multiple buildings within a 5-6 block radius. We bought a tremendous amount of land there. There's a total of 4 assemblages we really have that hopefully will be zoned for.
I know a lot of big developers moved to the area and started doing things over there.
So we got there. We tied up our first building, which was on the corner of Main Street and Buena Vista, directly across the street from the Metro North. So we're talking about prime location. I think that's Main and Main right there.
Right.
The building was unique, had 40 apartments and 4 retailers, but the 40 apartments, they were zoned live work. So we had a few companies in there as well. And the units themselves, it was a conversion. It used to be an old trolley barn. It was built in the early 1900s. It was converted in the early 2000s into these loft apartments with very high ceiling heights. So the apartments are about 1,400 feet each with 25-foot ceiling heights and a mezzanine. So, and they're really great apartments, very unique. And since we got there in 2016, we've seen a lot of the major national developers move in there and plant their flags. I mean, there are thousands of units that are in development or finished already in that market. So it's great to see.
Tell me something. COVID hits.
Yeah.
What's going on in your heads? Meaning, okay, COVID hits. What are you guys doing?
So I think we have to count our blessings because a lot of people got affected very badly.
Yes.
We weren't in hotels. We weren't heavy on office. We also didn't do any rent stabilized, which also had the issues pre-COVID.
Yeah, that's a pre-COVID issue that was major.
Right, and then even during COVID, the no evictions, and if people don't want to pay, there's really nothing that the landlord can do. So we didn't have any of those issues, thank God. We actually saw in Yonkers, our residential rents for the existing building were going up because of the uniqueness of the layouts and the apartments themselves, because there's a lot of space. So a lot of people liked, those units. So our rents were going up and occupancy rate was going up as well. Some of our smaller stuff in Manhattan and Brooklyn and Queens, we saw some decreases in our rent rolls, anywhere between 5 and 15%, maybe even up to 20% in some of the units. Some of the retailers had trouble, so we were working with them basically worked with our banks and worked with our retail tenants. But these were some of the smaller buildings, and thank God we didn't have tremendous issues with any of them. And it actually, on the positive note, it gave us a lot of time to deal with the city of Yonkers in terms of planning our developments.
Tell me something. When you had issues,
Yeah.
some issues, very few issues that you guys had. Tell me something. How was your experience with renters? Meaning, if you could go through it a little bit. Meaning, people called, okay, I'm in trouble. I lost my job. I'm assuming all kind of things like that. How are you guys handling that kind of stuff?
Sure. So we're of the mindset, we like to treat our tenants well. We feel we show respect, people will show you respect back. And especially, if there's one thing, if someone really can't pay and he lost his job, he has nothing, it's very difficult. So with our tenants, we would work out some payment plans with them. Maybe they'd pay a certain amount over time to make sure that they paid for their back balance if there was. If tenants, leases were up soon, and they left, we would have to re-rent them. They would, as long as they're current. But we didn't have it wasn't too many issues. If their lease was up, they paid. And again, because we treat them well,
Right.
Certain people they have self-respect, and they wanted to make sure that they did right by us, especially we're doing right by them. And I think with the retailers more, you'll see, some of them maybe getting half rent for a certain amount of time and then make it up a little bit later.
Right.
So we had to craft our deals also based on the type of forbearance that we would get from our banks. So we weren't really able to go to our retailers with a full plan until we know exactly.
And how was that? How was working with the lenders?
Thank God, it's been very good. It's been very good.
Yeah.
Yeah,
they were very considerate. You're saying.
Yeah.
Even with the retail.
Yeah, because again, our retailers are very service retailers. We have Dunkin' Donuts, we have a grocery store. Things that people still want and need. So it is a little bit different. We had one vacancy that since I think it was right before COVID they left, and so we've had a small space, only 500 feet, that we're still trying to lease, and hopefully as we come out of this, it will be okay. But again, it's a very small space. That's
no big deal. I heard a lot of horror stories about this. You guys, thank God. It sounds good. So tell me something. What is the prediction in your eyes in terms of where the market is going? I know you guys are very New York oriented, even though it's not. You did some Hartford stuff. You did all kind of things, but where do you see the market going?
So it's interesting. I'll rewind a little bit, and I'll come back to that question. But
Go ahead.
It's interesting because in 2015, at the end of 2015, the rates had gone up and rents kind of plateaued. So we kind of felt the growth was really stopping in New York at that time. And when rates go up, we were hoping that pricing would come down a bit. And it never really did. It didn't really translate. So we realized we could not be aggressive in New York, and that really the growth was either slowing down or really stopping. So we decided, okay, we have to go somewhere else where we feel, between a 3 and a 5 year window, that there will be growth. And we had one thought to go out into, Austin, Texas, and Nashville and Charlotte and all those other cities down south that we felt could have, big growth potential. At that point, it was the beginning of 2016. We thought, oh, we're too late. They're already selling at five caps, 5.5 caps. Yeah, it's too late. Meanwhile, we look back now. If we bought then, it would have been fantastic. But so
we don't have a crystal ball, as we call it. Yeah.
Right. So we decided to go in areas like Westchester and Bayonne, New Jersey, and we still, we've seen growth, and we believe there'll be a lot more to come as well. So now, the predictions, it's a bit tough here in New York. I always believe that New York will come back. I think the infrastructure, the arts, the culture, the universities, New York will always be a global magnet. So I think the question just becomes, how long will it take?
Yeah, but let me just jump in and
Sure.
tell you, because if you listen to my last show, I was actually discussing, the exodus from New York City and from the big cities, but particularly New York has suffered. And I don't talk politics in this on this show, but particularly New York is suffering from a couple of issues, and I would love to hear what your opinion is on that one because you are a very New York oriented business. So what I'm talking about is New York policies. That's a New York policies with the current mayor, the current governor. It's nothing to do with politics. It's everything to do with business, okay, and economy. Okay, no matter where you are in the political spectrum, it's something they have to look at because if you have a business, you have to understand what's going on, and that means rent regulations, which we know of, and issues on concessions that are going on, and evictions that are being postponed, and all these things that are not so landlord, let's say, friendly.
Right.
All these issues that are there. So that's A. And B, you have the issue of taxes. Okay, people just experience you're a New York based type of a business. You know what it is. You have to pay taxes in New York. So that's one thing that you have to experience, and that's something that you have to actually get the heat for. So that's B. And then you have the issue of the pandemic, and then you have the issue of the civil unrest and the social unrest that is coming up. Which again, no matter where you are in the social spectrum, it's all good, it's all great. But if you have a business, you have to take care of the business. You have to make sure that you're making money, and that's the bottom line. So, what are your thoughts about all that? And when you think about business in the future, what are you thinking?
Sure, I'd say two loaded questions. Probably speak from now till tomorrow about politics, but I'll
It's not politics. It's the one issue that is called New York City, and I did not attack it from the political view, but I attacked it, and I'm not talking politics. I attacked it only from the business view.
Policy.
You have business. What are you going to do with it? You see all these problems, and they're one. They're actually few, but they're one. What are you going to do?
So it's a great question. Policy, as I've seen it, again, I'll keep all my personal opinions out. The policy that I'm seeing and that we're all seeing really is very anti-landlord and really attacks the real estate industry. We saw it, right out there in full display when it came to Amazon. So it's kind of difficult to predict how much worse it can get. There's a reason why we never did rent stabilized. One, we felt that we're coming in, say, years later with no experience in that field, and we felt it was extremely competitive, especially because multifamily was always the safest asset class, and there were a lot of buyers in multifamily. So we felt we weren't going to do better than anyone else, and also that the rules, any type of regulations kept getting worse. So we kind of felt that as they, one day there was, another rule and then another regulation, and we kind of felt it was working against the landlords and getting harder and harder. We didn't think that it was going to reverse and become easier. So, we just felt like, all right, if it's getting worse and worse, this is not something we want to jump into. That was really the main reason, as opposed to the competition that's there. But it's hard to predict what's going to happen. I think, like you mentioned before, the taxes, that's also a little bit difficult. But in terms of policy, I'm just trying to think like a worst case scenario, what we would see. And it's there were some bills I think passed around in terms of making all of apartments kind of rent regulated, where you can't increase rents beyond a certain amount, and things like that. So that would be pretty detrimental. So there are other things. It was commercial caps on rents, things like that they were discussing. I'm not sure where they are right now, but I know that these types of policies would be very, very difficult. Now, because we're outside, a lot of our investments right now are outside of New York City, we're hoping that these aren't New York State regulations that might get into place. But again, we don't know. I would say on the taxes side, that's also a huge, huge issue. So part of me says, we're going to...
Huge issue. People are flying out of New York because of that.
Right. But I'm talking about on the property tax side. because I could only imagine that as things get better, they're going to start with the property tax hikes. That's one of my fears, is that we're going to see potentially some better cap rates, a lot of properties come to the market, small to mid-sized properties where people want to jump on. They'll see cap rates they haven't seen in a long time, and lower rents, and they might feel that's good value buy, and it might, it could be very well be that that's great.
Right.
I guess the issue looms is how much those property taxes, how much are they going to increase them? Because everyone I've been speaking with feels like it's inevitable that will happen. And it's a question of how much, and will that wipe away a lot of your increases? Will it be difficult with the loans you're taking out? So these are things we have to watch out for. Now, if I was running the city, a lot of policies that I would do, I would look at New York City and say, listen, we were once the only option for offices, on a global scale. Now you're seeing a lot of big companies moving down to Miami. I understand there's a mayor there who's working hard to bring a lot of tech companies and larger institutions down there. I think New York has to get in a certain mindset of, we got to compete to bring more businesses here, and we have real competition.
I don't think it's going to happen.
It's not going to happen. I'm saying if I was running the city, this is what I would do. But also, one of the
city is not pro-business right now.
That's
the issue. Social issues, and that's what it is. It's a fact of life.
Correct.
I mean, when you run a business, you have to look at it. Right. Exactly.
We'll have to see who the next mayor is, and to see what type of policies he'll want. But could it be worse than it is now? Possibly. I think we need to push to change those things. But again, I also see if New York gets a bailout, maybe will be much less of a hurt. But I also doubt that, because I think they'll still raise property taxes. They'll still, increase taxes as well across the board. But one thing that could bring in more revenue is that they were talking about legalizing marijuana now, and gaming, and sports betting. So those things could be big revenue drivers for the city and the state, and also could potentially help out with vacancy in retail. So if we see a lot of businesses, whether they're restaurants and other retail stores going out, that can open, hopefully fill with either gaming or dispensaries or things like that can hopefully.
Right. Okay, that's already right. That's a different discussion of how we take retail to another level. Right. So that's a different thing. Let me ask you this. I know you didn't bring your crystal ball, okay? But where's the next area? Where's the next best place to go to?
That's I'm going to say Yonkers. That's what I'm going to say.
Because you're there already. That's a different thing.
It's still going. It's still going. I think there's a lot more growth to be had there. There's a tremendous amount of value in that market.
You want to tell us a little bit who is there now? Like what type of people?
Sure. It's not
what it attract?
If you want to stay in the New York area and have an easy commute to the city, but don't want to be in the city, areas like Yonkers and Bayonne and maybe other areas in Hudson County are always great options. They're a little bit less dense, or a lot less dense, but you still have that urban feel. So, you'll have people who want to move completely to the suburbs. I think that'll be more potentially families or people who want to have a family. And still, like the younger people who might not want to be in the city and don't mind that short commute will go to those areas.
You want to pay a lot less rent, for sure.
Exactly, and you have a value there. So the people who are currently in downtown Yonkers, you have Extel, Avalon Bay, Mill Creek Built and Sold, China Construction, RXR, Rose Associates. There's a flex office space. It's about 800,000 square feet called iPark Hudson. It's right there in the downtown. They signed a deal with Lionsgate to build from what I understand, the first phase of 100,000 square feet, which will include 5 studios within that space.
What population do you have out there right now?
What do you mean? In terms of
what type of people, demographics?
Oh, you have all different types. It's really in that downtown. It's a very nice mix. You have people moving in from Manhattan that'll commute for work. This is pre-COVID. You have artists and musicians, photographers. And we have a lot. We have a lot of those tenants ourselves. And again, our building that we have that's existing is the multifamily is our lofts. So we have about 20% of those lofts are businesses or studios.
Right. And what ages are the people over there?
So the ages I mentioned before, which was the demographic we go after, which is the young professionals and the empty nesters. We're seeing a
Amazing.
lot of that.
Beautiful. So you're saying you continue to look at this area, at this market, as something that people, meaning you're going to go look after, and where you would recommend, so you stick to New York. You stick to the New York thought process, where the future is. It's going to take maybe time, but that's where everybody's going to come back to. That's what you're saying, pretty much.
Yeah, I always get tempted with Florida, but we have so much going on in the New York area. It's kind of difficult to go ahead and start looking into new markets right now.
Right,
But
exactly.
yeah, I do think Florida is going to be great. I can't tell you exactly which pockets, which neighborhoods, because haven't been doing much research and looking into it as much. But I do think that there'll be a lot of growth there. There already is, and other areas, as I mentioned, Austin and Nashville. These cities are very, very nice if you've ever been to them. When I was in Austin in 2015, there were cranes everywhere, a lot of construction going on. On Saturday nights, the streets were packed. It's a good feeling. So and now you're seeing a lot of companies moving to Texas, Austin specifically. So I think you want to follow the jobs. You want to find out where growth is. Follow the jobs.
Well, the jobs follow big companies today. So we have Elon Musk moving his old Tesla thing to Texas, and we have so many companies that are moving away. It's unbelievable. Or now we have Goldman Sachs. I just spoke about it last week. We have Goldman Sachs just indicated that they're going to move to Florida, and a lot of the financial companies district are moving there. So a lot of things are happening, and we have to just keep our eyes open. Keep our eyes open. I'll tell you something, Avi. Let me ask you this: how old are you now, if I may ask?
32.
32. Okay, 32. Where do you see yourself at the age of 50?
Count goggling, I get there.
Not really challenging you, not really throwing it at you.
Yeah. It's a good question. It's good to always think ahead, but you got to balance that with your thinking about the next day or the day that you're in present. So you have to have your present thinking along with the long-term goals. I think what AMS and what we're kind of transforming into is more of a development company as opposed to the acquisitions that we have done in the past. So I think looking ahead to 50 years old, it's a lot of development, a lot more development. I also think that it's a great skill to learn because as we've seen over the last several years, it's very hard to squeeze out that extra value in these existing properties. The pricing that they're going for today, it's almost like wealth management pricing. You're getting your small returns, and it becomes very difficult to actually get that growth.
You get 5% and beautiful 6%, and after with with financing, you get maybe 6 or 7 or 8, whatever.
Yeah,
so
if you're lucky. So I think the real value add will be and is, I think, currently already in development, and because there's a lot less people in the development as opposed to buying existing assets. You can find deals and be able to create outsized returns compared to the existing product. So I think
let me tell you
development.
We're getting tighter with time, but let me tell you that my take on development a little bit, because development, for example, when it comes to development, and I've been involved in that, meaning development is really a thing that I like, and got involved in it pretty heavily. But I'm saying when it comes to this, for example, and I'm talking mostly about the residential side of development. Okay, the only way to make money in development, my opinion, okay, when it comes to residential, retail is a whole different deal. You come, you build something for the future. You have to have deeper pockets and a lot more patient capital. But when it comes to residential, the way to cash out is obviously condos, selling condos. So you have to really know the market and where the needs are, et cetera, where the pack is going, and to go like Wayne Gretzky saying, said to go where the pack is going and to be there first, to go, go and expect where people are going. And the place is not so much New York City. We discussed that. But further than that, when it comes to multifamily game, it's only A class. It's only A class type of buildings. There's no money in development when it comes to the C or B. Do you have anything to say about that?
Sure. So that's where you kind of find the little pocket. I'm not sure exactly in your mind. Is that you're spending a ton of money trying to get max per foot. There's all different types. The high-rise luxury rentals is very different.
Right. Of course, A in the density and A in the suburbs, different things. Right.
Well, I have to say that I'll disagree with in terms of making money. You don't need to build condos to make money. And personally, I don't really like condos so much. I think at the end of the day, when you deliver is when you have to deliver. And that's dangerous, as we see. If you're building rentals, you don't leverage too much. If your rents go down a few points because it's a low time, God willing, eventually those rents will go back up and you're still holding the asset. And if you want to sell, you'll sell when that's up.
Okay, so you're talking about developing something that you'll hold for
rent.
the long
Yeah, rentals. And it doesn't
Okay.
It doesn't have to be a long-term hold. It could be, it takes you 2-3 years to build. You hold for 5, maybe hold for 7. But you maximize the value and then you're able to sell. These 55 plus deals, they're not luxury of luxury. And we rent it out. You make a nice return on the sale and you make real money. So I think that, look at areas like Jersey or Westchester where you could build wood frame construction. You could build for much cheaper. You could put in very nice finishes. Again, at a much cheaper pricing than you would in New York City, especially because the wood is development is 4 stories. You could do a 4/2 with the garage, or just a plain 4 stories with surface parking. It'd be a much cheaper build, and you can do nice finishes. And you're renting for, on a per foot basis, the high 30s to maybe mid to low 40s, and you could do very, very well there. So, we had looked at some areas in the summer in Jersey near train stations and, smaller downtown markets that are, not too far from the city by transportation. And those areas could be up and coming, and, you can rent them out for a decent prices per month, and you make a very nice amount of money on those types of deals. So it doesn't have to be only high-end luxury high-rise buildings.
Right. So, okay. So time is really running out. Avi, really, thank you so much. Stick around for a second. I'm just going to say my little farewell, little dance. Okay. Beforehand, I want to close with you just a couple of more seconds. That's it. Then I'll let you go. Thank you so much for your time. Thank you for being a part of the CRE Shakar show. And we got so much. It's really interesting. I think we could go forever talking about what we're talking about.
Sure.
But, and really stick around for a second. Thank you so much, Avi Abadie. I hope you guys enjoyed this show. Really, really awesome. And if you want to learn something from that, you can listen to it again. I'm telling you, there's so much to learn from Avi and his stories and his experience. And I'm telling you guys again, check out, if you're new to this and you want to understand what commercial real estate is, check out the courses, check out the links below or above or whatever you're watching. Check it out. Make sure that you actually get in. I have this 7-day challenge. I told you about this in a few other shows. 7-day challenge. And the first day of the 7-day challenge is absolutely free. Just go and click and get it. And I hope you guys will have a beautiful weekend. If If you celebrate Shabbos, have a good Shabbos. And in general, just enjoy it. Try to relax. And I'll see you guys on Monday. We have a really special show. I'm going to tell you about it soon. Take care of yourselves and goodbye.